So US Treasuries used to be the gold standard of safe investments. People all over the world, they buy US bonds as a risk-free investment. But that narrative today is starting to unwind. The traditional buyers, the big whales, are starting to exit. And everyday investors, people like you and me, we're extremely skeptical about holding US debt. And when investors they are skeptical about US Treasuries, they start demanding a bigger return. And because of this huge change, US bonds are going to get more risky to hold for everyone. In our lead story today, foreign central banks think twice on US treasuries. It's not a surprise that central banks are exiting US bonds. There are a ton of risks just by holding them. The US government has shown that they can use sanctions to freeze your assets, and that's a clear and present danger. But it's only the tip of the iceberg. The real fear here is growing US deficits, an inflation crisis that never ends, and the Federal Reserve losing control of the Treasury market. While foreign investors are still buying tons of US Treasuries, central banks are losing their appetite. The official sector's holdings are flatlining at best. In reality, they're actually being sold off. So why are central banks getting rid of the world's risk-free asset, and what does this mean for US bonds going forward? Now, when central banks buy treasury bonds, they want an asset that doesn't really move in value. If you buy a 10-year treasury bill, you expect the value to be relatively consistent over time. The last thing you want is a big crash in value when it comes time to cash in your bonds, which is exactly what happened over the last 24 months. Since the start of 2022, the Federal Reserve hiked interest rates from near zero to 5.5%, and that caused central banks to lose a ton of money on their bond holdings. Recall the relationship between interest rates and bond values. As the Fed raised interest rates to fight inflation, the value of US Treasuries started to crash down, and boy, did they crash down hard. According to Fidelity, a 1% increase in interest rates caused the value of a 10-year Treasury to crash by 9%. A 3% increase equates to a crash of 27%. So what happens when you jack rates up by 5%? You get a complete collapse in bond prices of over 40%. And that, ironically, is also the exact same time central banks, especially those in emerging markets, need US dollars. As rates go up, the dollar also rises, which forces central banks to defend their local currency. They have to scramble around for dollars, and where do they hold it? US treasuries. So many governments around the world they are booking a big loss selling their treasuries to raise the cash. It's a realized loss that wipes away the last 5 to 10 years of interest payments. Even if we take away the threat of US sanctions, putting all your cash in US debt is not a good financial strategy. Since 2022, we can see the holdings of US treasuries in central banks starting to drop. Just in November alone, central banks lost almost $50 billion in their treasury holdings. It's not a matter of holding your bonds to maturity. Treasuries are supposed to be stable in value, but because they no longer are, buying more in the future is a very big risk. That's why since 2008, the treasury holdings of central banks have been collapsing year after year. It went from over 40% to under 15% this year. That's a big drop that signals a big shift away from the supposed risk-free asset. This has big implications going forward for both the US and the world. The two biggest price-insensitive buyers of US treasuries are either backing away or they are just selling their holdings. The Federal Reserve is reducing their balance sheet, while foreign central banks are no longer buying. They might even be selling what they currently have. The danger here now is how new buyers are filling the gap, and these are banks, pension funds, and retail investors, and they are very price sensitive, which spells doom for the stability of the US Treasury market. Let's just take you and me for example, the average retail investor. If you're lending money to the US government, to Joe Biden, you are well aware of the risk. It's 2024 today and everyone knows the BS. If you buy a 10-year bond or God forbid a 30-year bond, you could get clobbered. Inflation in the US could well exceed your yield. Even if you hold it to maturity, you're still being screwed. Or if the US government suddenly defaults by printing the debt away, your buying power is going to collapse faster than the 4% yield you're getting. So naturally, you'll demand a higher yield to compensate you for all this risk. We know it's a game of musical chairs. Sooner or later, the music will stop and someone will lose their shirt. This new buyer base is likely to demand a heavy premium to finance Washington's spendthrift ways. And it's only going to get worse because Joe Biden is spending money like never before. The supply of US treasuries keeps on climbing. 20 years back, it used to be only 3.6 trillion of debt outstanding. This has grown to $26.4 trillion back in December. And if you look at the trajectory of the growth, it's getting steeper and steeper over the years. More bonds are being issued because deficit spending is also rising. This is a big problem where traditional buyers like central banks are running away and you have bargain hunters replacing the demand. These are investors and speculators who demand higher yield. They aren't afraid of dumping their bonds to head elsewhere. They aren't interested in holding all the way to maturity. Take the recent speculation about the coming Fed rate cuts. The markets are now pricing in 4 to 5 cuts, with the first one coming in March. But because of inflation rebounding, investors are running away. JP Morgan clients are cutting their long bets on US Treasuries. It used to be almost 40% in November, but it's crashing down to 20%. And this is a sign of heavy speculation in a market that's supposed to be very boring. The implications are big, guys. Going forward, the US Treasury market is fast becoming a casino filled with wolves. Because people are demanding a bigger premium to hold US bonds, we can kind of expect two things to happen. Bond yields, by extension, interest rates in the real economy will drop slower than we all think, unless, of course, a recession hits. Plus, we can also forget about a world of zero interest rates anymore. The jig is up, the best buyers are long gone because of the Fed and the US government. The world's biggest bond market is now in a royal mess. And speaking of a big mess, let's shift our focus to US and Russia. Because what's happening is going to trigger yet another exodus away from US assets, including treasury bonds. We said before that total confiscation is coming for Russia and there's no escape. And this breaking update all but confirms this. A US Senate committee approved legislation on Wednesday that will help set the stage for the United States to confiscate Russian assets. We could see America's first ever seizure of a country's assets that it is not at war with. Out of 21 votes, 20 people voted in favor of the Repo for Ukrainians Act. Over 95% of the committee approves of this. The only single objection came from Senator Rand Paul. This bill now passes on to the rest of the Senate and the House, which I bet will likely get passed as well. And once President Biden signs this into law, it's effectively over for the frozen Russian reserves. It's just a matter of time before the 300 billion gets confiscated for Ukraine. It's a very dangerous bill because it weaponizes the US financial system to a whole different level. According to Senator Jim Risch, the bill is a big hammer. It's intended to be a very new way of attacking a country that does not behave itself. In other words, if you misbehave, the US government can confiscate your sovereign assets. It's a really slippery slope that threatens to undermine whatever confidence is left in Western assets. If you think central banks dumping US bonds today is bad, just wait until this legislation becomes law. You'll see an exodus of money fleeing. And why is this happening? Well, because US funding is still in the deadlock, and deep down, Biden knows he can't keep issuing bonds forever to fund Ukraine. The economic crisis in Ukraine is getting from bad to worse, and they are going broke. From Wall Street Journal, Ukraine has a $30 billion funding gap. The aid from the West was supposed to cover this amount. And because the 60 billion isn't coming fast enough, Ukraine is running out of money. Kiev might be forced to delay salaries or even return to money printing. Obviously, this will wreck what's left of Ukraine's economy. If the money doesn't come soon enough, Ukraine might be forced to fire people or increase inflation to pay off their military. And you can already see how ugly this can get. There could be internal revolts in addition to fighting the external war against Russia. With this new repo law, America can seize more money on top of Biden's $60 billion to give Ukraine. This also gives the collective West a new framework to confiscate the reserves as well. Once America writes the new rules, the EU will have more justification to hop onto the bandwagon as well. After all, they are already moving ahead with or without the US. From Bloomberg, EU moves ahead on plan to tax gains of frozen Russian assets. The plan is only to target the interest earned on the frozen money and not the capital. They call it a windfall tax, but it's still a type of seizure. The Belgian finance minister is very optimistic about taxing the assets, but even Germany knows it is not a good idea. It's also important to respect the rules-based international order, international law, and financial stability. He knows the blowback effects of this and how horrible the backlash might be. While Western countries might still trust the US and Euro bonds after this, he's still worried about the global south. What will China, India, and the Middle East think about this? If this happens to Russia, there's no guarantee it won't be used again in the future. There will always be future conflicts, and the temptation to confiscate assets if a country doesn't behave is always there as well. And going forward into the future, there's no escape if you're a target. The US is looking to overhaul the entire Treasury market, which will make every single transaction traceable. America is moving to rewire the entire US Treasury market. They're going to force Treasury trading into a central clearinghouse. On the surface, this looks like a non event, but if you understand the mechanism, you'll realize that this goes beyond just increasing efficiency. It makes everything transparent. And this is what the US Treasury market will look like in the future. Buyers and sellers will be dealing with one central clearinghouse. The technical reasons for this seems reasonable. It prevents a systemic collapse of the financial system if one counterparty can't pay the other. By having a central clearinghouse, you consolidate liquidity together so a total market crash will be much harder to happen. This is especially important to prevent another '08 collapse. But on the flip side, it also allows complete traceability of counterparties and what they do. It allows you to identify who's doing what, which is a very powerful tool for the US government, especially when it comes to sanctions. Now, back in 2017, only 13% of US Treasury transactions were centrally cleared. The majority of transactions are settled outside of the system, so there's limited oversight. And once this reform happens, if you want to buy or sell US Treasury bonds, you have to use this central clearinghouse. If one day a country misbehaves, right, the US government can theoretically identify how many treasury notes you own. Now, I'm sure they can already do it today, but you'll get much more efficient in the future. This also means getting out of your position will be impossible as well. If you suddenly sell a ton of US bonds, that will raise red flags. If we consolidate everything together, the financial risk and the geopolitical fear is easy to project the future. The US Treasury market will get less popular with global central banks. It will be mainly commercial banks, retail investors, and hedge funds that will buy and sell these bonds. For you and me, the implications are simple. Bond yields will continue to be volatile, and heading back to 0% or ZERP will be rather impossible. The markets will demand a higher yield today compared to 10 or 20 years back. And as central banks move away from US debt, they have to store their reserves elsewhere, and I'm very sure a big percentage will flow into physical gold. But let me know what you think in the comments below. Will central banks move further away from US bonds? And is it all over for the frozen assets? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.